Welcome to The Explainer. Today, we're going to pull back the curtain on a couple of core ideas in corporate finance, how companies actually pay for their huge ambitions, and then how they manage all the crazy risks that come along for the ride. You know, it sounds like the start of a bad joke, right? But the truth is, they all wrestle with the exact same fundamental financial problems. First, how do you get the cash you need to grow? And second, once you're growing, how do you keep the financial risks from bringing the whole thing crashing down? Okay, so let's start with a story you've probably heard before. Picture this, a company that's absolutely crushing it. Sales are up, customers are thrilled, and they're ready for that next big leap. There's just one tiny problem. Their ambition is way bigger than their bank account. They've hit a wall. You see, the cash they're pulling in from just, selling their stuff day to day, it's just not going to cut it. Those profits, what we call retained earnings, are fantastic for keeping the lights on, but they're not going to build a brand new factory. So they have to go out and find some serious outside money. All right, so they need outside money. Easy enough, right? Well, not so fast. Raising money, it isn't free. Not even close. Every single new dollar a company brings in has a price tag attached. And that brings us to this really key idea, the marginal cost of capital. In plain English, it's the cost of that very next dollar you need to raise. And here's the kicker. The more money you raise, the more expensive it gets. It's because every new investor looks at your company, sees a little more debt, a little more risk, and they demand a higher return for their trouble. And this chart? It lays it all out perfectly. Check it out. The first pile of cash, the money from the company's own profits, is the cheapest money you can get. But look what happens once that runs out. Right after the $1.2 million mark on the graph, the cost of capital literally takes a step up. You are now paying a premium to get money from the outside. So how do they actually figure out this cost? Well, forget a crazy complex formula. Just think of it like a blended cost. You take all the different kinds of money, debt, different kinds of stock, your own earnings, and you average out their costs based on how much of each you're using. And notice, they all have different prices. That's because they all carry different levels of risk for the investor. So you stir all that together, and what do you get? You get this number, 16.14%. And let me tell you, this number is a huge deal. This is the new hurdle. Any new project, any expansion, any big idea has to earn a return higher than 16.14% just to be worth doing. It's the new financial benchmark for the entire company. All right, awesome. Our company got the cash. The new factory is a go. But you know how it is. New money, new problems. Suddenly they're exposed to all sorts of financial storms, wild, unpredictable swings in the price of raw materials, or what foreign currencies are worth. So to protect themselves, the first thing they have to do is figure out where they stand. In the world of finance, this boils down to being either long or short. If you're long, like a farmer holding onto a crop, you want the price to go up. If you're short, like a company that knows it needs to buy that crop later, you're actually hoping the price goes down. Okay, so how do you actually shield yourself from these wild price swings? Well, companies use these really cool financial tools called derivatives. Think of them like an insurance policy. And the most fundamental, most common type of derivative is the option. First up is the call option. This is basically your bet that a price is going to go up. But the magic words here are right, but not the obligation. You pay a small fee to lock in a purchase price, but you don't have to go through with it if the deal ends up being a bad one. And this graph shows the payoff perfectly. Look at the buyer's line. Their potential profit, it's literally unlimited. The sky is the limit. The higher the price goes, the more they make. But their risk, their downside, it's capped. All they can possibly lose is that small fee they paid for the option in the first place. The seller, of course, is on the complete opposite side of that bet. Let's make this real. Imagine you pay $3 for the right to buy a stock at $100. Then the stock shoots up to $105. Boom. You exercise your option, you buy the stock at your locked-in price of $100, and you can immediately flip it on the market for $105. After your $3 cost, you just made $2 a share. Not bad. Now, if a call is a bet that the price is going up, what do you think a put option is? Yep, you got it. It's the exact opposite. It gives you the right, but not the obligation, to sell something at a locked-in price. It's your bet that the price is headed down. And just like before, this graph tells you everything you need to know. For the person who bought the put, the lower the price drops below that guaranteed sale price, the more profit they make. It's a fantastic way to protect the value of something you own. Seriously, think of this as straight-up insurance. Let's say you own a stock and you're getting nervous. You pay a small fee, $3, for a put option that lets you sell it at 100. Then the stock tanks to 92. Do you care? Nope. You use your option, you sell your shares for that guaranteed $100, and you just saved yourself from a big loss. And when you put them side by side like this, it just clicks, right? Calls and puts, they're just two sides of the same coin, perfect mirror images of each other. They're powerful tools for playing offense or defense in the market. But wait, there's more. Options are cool, but they're just one tool in a whole toolbox that companies use to manage risk. Let's really quickly touch on a couple of other big ones. Okay, this is a really important difference to get: an option versus a futures contract. An option gives you a choice. It's the right to do something. A future is an obligation. You are locked in, no backing out. I love this analogy. An option is like making a dinner reservation. A future is like signing a legally binding contract to buy the entire restaurant. And then you've got swaps. They sound complicated, but the idea is simple. It's just an agreement to trade cash flows. Let's go back to our airline. They might earn tons of euros from ticket sales, but their fuel bill is in US dollars. A currency swap lets them trade one for the other, which can totally eliminate their currency risk. Pretty smart, right? All right, let's zoom back out and tie all these threads together. Let's look at the whole journey our company just went on. So, at the end of the day, what's the big takeaway? It's this: none of these ideas exist in a vacuum. It's all part of a logical story. To get bigger, you need capital. That capital always has a cost. And once you've got that hard-won growth, you have to protect it by managing the inevitable uncertainty of the world. And that brings us to the final and maybe the most important question of all. These tools are amazing for managing risk, for playing defense, but they can also be used to make huge speculative bets to play offense. So where do you draw the line between responsible financial protection and just flat-out gambling? That is the billion-dollar question that keeps CEOs, regulators, and investors up at night.